One of the comments I always see about General Motors and legacy automakers in general is that they're carrying a ton of debt on the balance sheet. Technically, General Motors has about $129 billion worth of debt on its balance sheet. But is that really debt the way that we normally think about debt in companies, or is there a different story going on? And the truth is, this is very different than the debt that a lot of companies carry on their balance sheet. They do not need to pay for $129 billion worth of debt. In fact, GM, the automaker itself, has a net cash position. So I'm going to go through the numbers today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. And I'm going to jump today straight into the balance sheet. This is from GM's most recent earnings report. And what we need to focus on here is this left side. This is June 30th, 2024. And what GM does is it breaks down the combined balance sheet, the consolidated balance sheet between Automotive, Cruise, and GM Financial. These are the three businesses that are essentially separate under GM. So let's start with GM's automotive business. And down here in the liabilities, you see the debt that's on the balance sheet. There is short-term debt of $1.146 billion. There's also long-term debt of $15.395 billion. If you add those two together, you get $16.54 billion worth of debt for the auto business itself. Now, the other thing the auto business has is a lot of cash and marketable securities on the balance sheet. So if we add back $13.97 billion of cash and $8.3 billion in marketable securities, you actually get a net cash balance on GM's auto business of $5.74 billion. So GM, the auto company, has a net cash balance. They could actually be paying down debt. Now they're choosing to buy back stock instead because the stock's trading for 4 or 5 times earnings right now. But that's the truth behind that business. Now, Cruise, much smaller business, about a $1.1 billion worth of cash. There is $2.2 billion worth of debt on the balance sheet, but this is a startup. I wouldn't really be concerned about the balance sheet for Cruise at all. It is also a consolidated business, but GM does not own 100% of Cruise. GM Financial, very different story. $37.2 billion worth of short-term debt and $72.9 billion worth of long-term debt. There is also some cash on the balance sheet of $7.4 billion, but the entire point of GM Financial is to be offering financing to people who are buying GM vehicles. This is the GM Financial site. If you have ever bought a GM vehicle or you leased a GM vehicle, you may actually have an account with them because this is where you do all the financing. So the auto business operates as a completely separate business. The financing business operates as its own business, and it has a balance sheet that looks a lot more like a bank. If you go through a balance sheet like JP Morgan Chase, you don't look at this balance sheet and say, hey, look, they only have $29 billion worth of cash on the balance sheet, but they have $392 billion worth of debt, or $2.4 trillion worth of deposits that they're going to have to come up with, $216.5 billion worth of Fed funds. Bank balance sheets just don't look anything like traditional manufacturing or consumer goods balance sheets. So that's why you need to look at GM's financial balance sheet much, much differently. In fact, from a debt perspective, as long as they're generating positive EBITDA or generating positive returns on these loans, I would say you can ignore the debt number on the balance sheet for the most part when looking at GM stock. Just look at the debt that is associated with the auto business, and like I said, that is a net cash balance today. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So why would an auto company do this, and what sort of risk does it pose for the balance sheet and the business overall? Well, the first reason that you would do it is if you're trying to sell a piece of hardware, an automobile, that's going to cost anywhere from $20,000 to over $100,000 for just one purchase. A lot of consumers are going to want to have some sort of financing available. So as you work with dealers, you want to have dealers have multiple financing options. GM Financial is at least going to be a baseline option. Now, if you're choosing a loan from a GM dealer, you may not choose a GM Financial loan. There may be a better loan from somebody else, but they're going to know that there's at least going to be one offer likely available for at least consumers who have the right credit to buy a vehicle. So that's going to be the reason that they're going to do that. And GM does this, Ford does this. All of the major automakers, at the very least, work very closely with a number of financing arms, and they don't necessarily want to have all of their financing under GM Financial, but they do want to have that product be available. It's also where a lot of the leases go. So when GM makes a lease offer, it's not GM that's keeping that asset on the balance sheet, it's actually GM Financial that's doing that. So there are very good reasons for a company like GM to have a financial arm attached. But this does bring interesting risks into the business. There is now credit risk, there's interest rate risk. So if people stop paying their car leases or car loans, that's going to disproportionately flow to GM Financial and lead to a lot of losses. This is one of the things that became a real challenge during the great financial crisis, is that not only did GM's sales fall, but their financial arm, which is now Ally Financial, ran into its own problems. So they not only have to get debt to be able to offer to customers to buy loans, but they also have to count on customers to pay those loans. So when unemployment went up, the payback on those loans didn't live up to their expectations financially. So there are now financial risks that are associated with General Motors, but it doesn't mean that there's another $100 billion worth of debt on the balance sheet. And it doesn't mean that GM itself has a bad balance sheet or is a bad value. In fact, GM as an operating company is expecting to generate about $10 billion in free cash flow this year. The company's market cap is only about $45 or $50 billion, and they're going to buy back somewhere around 20% of the shares outstanding in 2024. You can see here the incredible pace that they've been buying back stock, and this chart doesn't actually do the buybacks credit because there's now only about 1.14 billion shares outstanding. Management thinks they can get that down to about 1 billion shares outstanding in about the next year or so. So this is a phenomenally cheap company that has some interesting quirks to it related to the fact that it has a financial arm. But don't let that dissuade you from a company like this, because it's really the auto business that you want to analyze, because that's the core of GM and GM stock. That's where most of the cash flow comes from, and that is actually the reason that GM Financial exists at all. So as long as they manage that financial business, I don't think it's a huge risk to the business overall. But hopefully that gives some detail into why GM Financial is part of GM in the first place, and why the debt that sits on the balance sheet at GM Financial should not be as concerning as other debt that may be on the balance sheet, in particularly on the auto side. And one of the things to keep in mind is that GM, the auto business, is net cash positive. So always keep that in mind when you're looking at GM stock. But let me know what you think about GM stock and its balance sheet. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.